Let's welcome in James Sullivan, Head of Equity Research for Asia ex-Japan at JPMorgan. He joins us from the JPMorgan India Investor Conference, which is happening in Delhi. James, thanks very much for taking out the time and speaking with us. What's been happening in the emerging market equity basket in terms of the market performances? The MSCI Emerging Market Index itself is moving towards the bear market. Shanghai now is down 23% from its peak in January. We saw the same with Hang Seng earlier on. So it looks like the sentiment is just driven lower because of various factors. Do you see that changing anytime soon, or it's still going to be a little bit of a way down?
Thanks very much for having me this morning. I would say there's two primary drivers of emerging market performance relative to developed markets. Number one is the earnings growth differential in emerging markets relative to their developed market peers. Number two are currency trends. And on both counts, we've seen actual numbers that have been very negative for emerging market performance on a year-to-date basis, which in JPMorgan's perspective is what's been driving that underperformance year-to-date. Now, the key question, as you say, is very much the outlook moving forward. We are looking at positioning in the US dollar, which has dramatically changed from January. In January, almost the entire market was short the dollar. Now almost every single market participant is leaning long the US dollar, so dramatically different positioning. In emerging markets as well, you went from a situation where you saw very significant EM outperformance in 2017, very long investor positioning, which again is no longer the case. So from a market positioning perspective, both in the dollar as well as EM equity markets, we do think we're looking at the potential for outperformance moving forward. What we need to see from here is stabilization of the US dollar and selective earnings upgrades across the emerging markets here in Asia.
Good morning, James. Hi, this is Darshan here. What's the sense at the conference when you speak to people? You must have spoken to people there, here in India, across Asia before you came here. What's the sense that investors have for emerging markets and especially India?
The conference is actually just kicking off, and so we'll learn more over the course of the next couple of days. We've got, I think it's 4 cabinet ministers from the Indian government presenting, as well as a very large number of CEOs and senior management officials from some of the key Indian corporates. What I will say is we're looking at an interesting situation for the Indian equity market. Number one, investors are actually positioned very long India. That's very different from what we see in regional markets like China, as an example. Number two, if I look at the earnings revision trend, which we just referenced, earnings revisions here in India have been very negative over the course of the past couple of quarters, but I'd make 2 points. Number one, we're starting to see a moderation of those negative earnings revisions. In the past quarter, it was actually the smallest negative earnings revision that we've seen over the course of the past 4 quarters. We're also starting to see some specific sectors pick up and actually see positive earnings revisions. And so specifically, I'd mention healthcare, IT services, as well as manufacturing. So a lot of our sectors that are more exposed to the currency trends and actually benefiting from some of the INR weakness that we've seen over the course of the past couple of months.
That points it out to the macro side of things, the earnings, internal, corporate performances. But on the macro side of things, we still face pressures. While the GDP growth numbers look encouraging, optically, if you look at CAD, what's been happening at it being at a 5-year high for the country now, fiscal deficit pressures, considering currency weakness. Does that paint a really, risk-averse picture for someone sitting outside India and trying to make investments?
I think it's important to recognize where we've come from and where we're going moving forward. Where we've come from is an environment where markets had absolutely not priced in a more aggressive Fed, particularly into global bond markets as of January this year. We now think that the level of rate increase and rate hikes that we have in the forecast, which is every quarter from now until the end of 2019, is adequately priced into global bond markets. And that has a very meaningful impact in terms of currency trends moving forward. Also, particularly relevant to the Indian market is we are sitting with oil at close to a 4-year high. We don't see significant upside to oil moving forward. If anything, there's some supply side risks to the upside, but we don't see as meaningful a move over the course of the next 6 months as we just saw on a year-to-date basis, which should indicate that some of the pressure that we've seen on current account deficits across the region, but particularly here in India, do begin to mitigate on a go-forward basis.
James, you highlighted what's been happening to crude, and I want to pick up from that point because yesterday, we had news that Saudi Arabia is okay with crude being at $80 per barrel. I mean, now you've got the Iran sanctions coming up in the month of November. Supply constraints are going to be built in. Do you see that as being a significant negative in the near term?
So there, as you say, there are very clearly some supply constraints to watch out for. 2 points that I'd make. Number one, those are very well known and are very much priced into forward markets for the overall energy complex in our view. Number two, the other side of the equation is obviously the demand side of the equation. At JPMorgan, we just took down our GDP growth forecast for both the European Union as well as Japan, and we're looking at the US as really the sole driver of the global economy at this stage. So on the demand side, I think we can start to highlight some potential areas of weakness moving forward that may start to offset some of the supply concerns that we've had.
Internally, what are the targets that you have put in as far as crude is concerned? Where do you see it topping off, or do you see the rally probably continue?
So again, incrementally, there are some supply side risks to the upside going forward. We think that is offset by some of the demand side of the equation, as we just discussed, as we see relatively flat prices moving forward.
And a word on the ongoing trade issues between US and China. What's your take on it?
So we've publicly taken the view that there is very little hope for an off-ramp to these conversations in the near future. Ultimately, we've seen several polls come out of the United States over the last couple of days that show that high tariffs are a winning electoral issue for the Republican Party. So the idea that they're going to back away from this issue as they walk into a very contentious midterm conversation, I think, is very unrealistic. If you then look at the politics within China itself, it's hard to argue that President Xi will start to back away, and they've made very public comments that they will not bend to the pressure that they're currently seeing from the United States. And so I think the base case has to be a continuing ratcheting up of trade tensions, that the tariffs that have been discussed as possible will actually become reality, and that it's very difficult to see this situation getting better in the near future.
Just one last question from me, James. Historically, an election year and the run-up to the election year has been positive for the equity markets. Up until a few days back, before the correction started on the Indian indices, we actually had a good 10% bump up on the Nifty as well as the Sensex. Do you expect volatility to be a key factor that could weigh down sentiment, and we need to watch out for it very closely?
I think volatility is absolutely the most important word for this market over the course of the next 6 months. If we look at our FY19 index targets, we've got about 10 to 15% upside for the broader Indian indices. But as you very rightly say, the market has performed well, particularly relative to the rest of the region. We have a situation where investor sentiment, as expressed in positioning, is already very long. And so we need to see incremental drivers of outperformance. It's difficult to say that you will continue to see the type of valuation push to the market that we've seen over the course of the past 12 months. So our belief is it absolutely has to be based in the earnings cycle. And there we'd be very selective. As we said at the top of the program, we are seeing selective positive earnings revisions. I'd specifically call out healthcare, IT services, and the materials space. Again, those sectors that are more leveraged into INR weakness are the ones where we're starting to see this turnaround and starting to see a broader basis for outperformance moving forward.
Got that. James Sullivan, thanks very much for joining us. It was a pleasure chatting with you.